is in trouble. And it's in trouble because of lack of leadership. And as President John Kennedy said, leadership and learning go hand in hand, basically.
In a world marked by economic uncertainties, financial educator and renowned author Robert Kiyosaki issues a stark warning that reverberates with apprehension. Banks will seize all your money in this crisis. This proclamation, culminating in his lifelong financial insights, has ignited debates and raised eyebrows globally. This is quite an important debate to discuss, and today I will be helping you to understand why Robert Kiyosaki has given this warning. The source of the warning. Kiyosaki's own trajectory casts a shadow of credibility over his declaration. His notable work, Rich Dad, Poor Dad, a tome of financial wisdom, has traversed the lives of countless readers, imparting lessons in financial literacy and alternative pathways to wealth accumulation. His fundamental message resonates with individuals who want to safeguard their financial destiny and is built on the strength of education and smart thinking. But Kiyosaki's literary talents aren't the only thing that gives his claim weight. The author of the letter, who has experienced his fair share of financial turbulence, draws comparisons between his own life and the current state of the economy. The furnace of real-life problems has sharpened Kiyosaki's viewpoint as he has endured recessions and market volatility.
Money is debt. I use debt as money. And everybody thinks getting in debt is bad. Well, who told you that? I think the stock market is for losers. Why would you put money in the stock market when it's manipulated?
His warning is based on instances in previous financial crises when financial institutions were subjected to unmanageable pressures, which had disastrous effects on account holders. He urges us to face the specter of possible catastrophes head-on by placing his remark amid this tapestry of historical occurrences. Understanding financial crises. Financial crises are like sudden storms that sweep through the world of money, leaving behind a trail of chaos and uncertainty. Imagine a giant wave crashing onto the shore, disrupting everything in its path. That's what a financial crisis can feel like for economies, businesses, and individuals. To understand a financial crisis, think about a delicate balance. In the world of money, there are lenders, like banks, and borrowers, like people and companies. The balance is stable when everyone is paying their debts and things are going well. But sometimes things change. Jobs might disappear, companies struggle to make money, and people can't pay back what they owe. This imbalance can trigger a financial crisis. Imagine if a lot of people can't pay their mortgages at the same time. Banks might lose a lot of money because they were expecting that money to be paid back. People lose their jobs, families struggle to make ends meet, and businesses shut down. Governments and central banks often step in during crises to stabilize things, but it can be challenging. Understanding financial crises is crucial because it helps us be prepared. It's like knowing that a storm might be coming, so you can batten down the hatches and stay safe.
This is the biggest crash we'll ever see in our lifetimes. It's called the everything bubble. Everything's going to come down. And that's how you can prepare for it. So for most people, that's bad news. Crashes, everything goes on sale.
The role of banks in financial crises. Banks are like the heartbeats of economies, pumping money and credit to keep everything running smoothly. But when a financial crisis hits, this steady rhythm can turn into a wild dance of uncertainty and risk. Picture a puzzle where each piece represents a part of the economy. Banks hold a critical piece in this puzzle because they are responsible for lending money to people and businesses. They take deposits from you and me and use that money to provide loans to others. This cycle keeps the wheels of commerce spinning. However, when a financial crisis emerges, banks often find themselves in the eye of the storm. Think of it as a sudden gust of wind that knocks down some puzzle pieces. Banks might suffer losses if people lose jobs and can't repay loans. This can weaken their ability to lend more money to others. A major concern during a crisis is a bank run. This is when many people rush to take out their money from banks, fearing that the bank might collapse and they will lose their savings. It's like a crowd rushing toward an exit during an emergency. This rush can cause a bank to run out of money, leading to more economic problems. Governments and central banks step in during these times to play the role of firefighters. They are central to the financial puzzle, but their vulnerabilities can ripple throughout the economy. This is why regulations and safeguards are in place to ensure that banks have enough cushion to absorb losses without collapsing. Banking regulations and safeguards. Just as a ship needs a captain and a compass to sail through rough waters, the world of banking relies on regulations and safeguards to navigate the stormy seas of financial crises. Imagine a game with rules that everyone must follow. Banking regulations are like those rules, but they are not just for fun. They are designed to keep the financial system stable and protect your hard-earned money. Governments and financial authorities set these rules to ensure that banks operate responsibly and manage risks effectively. One crucial aspect is capital requirements. This means that banks must keep a certain amount of money as a safety net. It's like having spare tires in a car. They are there in case of a flat tire. Another critical safeguard is deposit insurance. Think of it as a safety net for your savings. If your bank were to collapse, the government guarantees your deposits up to a certain limit. This gives people the confidence to keep their money in banks, even during uncertain times. To illustrate the importance of these safeguards, consider the aftermath of the 1929 stock market crash. Many banks failed during the Great Depression, leaving depositors without their money. This crisis highlighted the need for stronger regulations and protections. Governments worldwide established regulatory agencies to supervise banks and ensure they follow the rules. Understanding banking regulations and safeguards is essential because they provide a safety net for individuals and the broader economy. They aim to balance allowing banks to operate efficiently while preventing reckless behavior that could lead to a crisis. The mechanics of seizing deposits. Imagine waking up one day to find your bank account suddenly frozen or your money gone. It sounds like a nightmare, but in the world of finance, understanding the mechanics behind seizing deposits is crucial to navigating the landscape of financial crises. When a bank is in trouble, there's a possibility it might not have enough money to cover all its obligations, including deposits. In extreme cases, authorities might step in and use a process called bail-in. This means that a portion of the bank's liabilities, including deposits, could be used to stabilize the bank. To understand this concept better, think of a puzzle where each piece represents a bank's assets and liabilities. When a bank faces losses, the balance between what it owes, liabilities, and what it owns, assets, might be disrupted. Authorities might use a bail-in to shift some of the burden from taxpayers to the bank's creditors, including depositors. This is where regulations come into play. Governments often establish rules to ensure that banks maintain a sufficient buffer of capital and assets. These rules are designed to prevent a bank's problems directly affecting depositors. To illustrate, consider a hypothetical scenario. Bank A is facing severe financial difficulties. Regulatory authorities step in and decide to apply for a bail-in. They might convert a portion of Bank A's liabilities, including certain deposits, into shares or other securities. This action helps recapitalize the bank and protect its stability. It's important to note that bail-ins are considered a last resort. Authorities prefer other measures, like government intervention or financial assistance, to prevent depositor losses. Deposit insurance often protects deposits up to a certain limit, which provides a safety net for savers. Assessing the validity of Kiyosaki's warning. Now that we have explored the ins and outs of financial crises, the role of banks, and the mechanisms that could affect deposits, it's time to put on our thinking caps and assess Robert Kiyosaki's warning, banks will seize all your money in this crisis. Remember, just like we evaluate weather forecasts before carrying an umbrella, we must evaluate financial warnings before making big decisions. Kiyosaki's warning grabbed our attention, but let's break it down step by step. Here's what you can do. Stay informed. Keep an eye on the news and financial updates. Being aware of changes in the economy can help you make informed decisions. Diversify. Don't put all your eggs in one basket. Spread your money across different types of investments like stocks, bonds, and savings accounts. Know the rules. Understand the rules and safeguards that protect your money in banks. Deposit insurance, for instance, can provide peace of mind. Talk to experts. As you'd ask a friend for advice on fixing a bike, consult with financial advisors. They can help you understand complex topics and make wise choices. Stay calm. Keeping a cool head is crucial even during uncertain times. Panic can lead to hasty decisions that might not be in your best interest. Preparing for financial uncertainty. Life can be full of surprises, some pleasant and others less so. Just as we keep an umbrella handy for unexpected rain, it's wise to have a financial umbrella for times of uncertainty. We can now discuss the practical measures you may take to get ready for financial setbacks and confidently get through tough times. Build an emergency fund. Consider this fund your financial safety net. Set aside some money in a separate account that you can tap into if unexpected expenses arise, like medical bills or car repairs. Having this cushion can prevent you from relying on credit cards or loans in times of need.
An emergency funds is 3 to 6 months of expenses, and so the income isn't as relevant of a piece of this equation. Start to look at, hey, what does it take for us to live in a single given month for our basic expenses?
Budget wisely. A budget is like making a roadmap for your money. List your income and expenses to see where your money goes each month. This helps you identify areas where you can cut back and save more. Reduce debt. Debt can feel like carrying a heavy backpack. Focus on paying off high-interest debts like credit card balances. The less debt you have, the more financial freedom you'll enjoy. Diversify investments. Don't put all your financial eggs in one basket. Spread your investments across different assets, stocks, bonds, real estate, to reduce risk and increase potential returns. Stay insured. Health, home, and car insurance are protective shields. They can help you avoid massive financial setbacks in case of unexpected events. Learn and educate. The more you know about finances, the better you can navigate challenges. Read books, take online courses, and stay informed about economic trends. Mindful spending. Before purchasing, ask yourself if it's a need or a want. Practicing mindful spending helps you make conscious choices and save more. Stay flexible. Life doesn't always go according to plan. Be open to adjusting your financial strategies when circumstances change. Invest in yourself. Developing or improving new skills can enhance your earning potential and boost your resilience in uncertain times. Review and revise. Regularly assess your financial situation and goals. As life evolves, your financial strategy might need adjustments. Critical thinking and due diligence. Critical thinking and due diligence are the twin engines that power your journey through finance. By cultivating the following skills, you become an empowered decision maker who can sift through the noise, separate fact from fiction, and chart a course that aligns with your financial goals and values. Question everything. Critical thinking involves asking questions, even when something sounds convincing. Just as you'd ask for more details in a mystery story, dig deeper into financial claims to understand their reasoning. Evaluate the source. Just as you'd check a recipe's credibility before cooking, assess the credibility of the sources behind financial predictions. Are they experts in the field? Do they have a track record of accurate forecasts? Seek diverse perspectives. In the same way you'd consult multiple reviews before buying a product, seek out different viewpoints on financial matters. This helps you get a balanced picture. Research thoroughly. Imagine building a puzzle. Every piece counts. Similarly, research thoroughly before making financial decisions.
People do not think critically enough. I mean, critical thinking is a skill in short supply, where people take too many things they assume too many things to be true without sufficient basis in that belief. It's very important that people closely analyze what is supposed to be true and try to build up. Try to say let's analyze things from first principles, not by analogy or not by convention.
Understand the context, history, and potential impacts. Stay skeptical of extreme claims. Just as you'd be cautious of miraculous health claims, approach extreme financial predictions skeptically. Balance is key. Seek professional guidance. Just as you'd consult a mechanic for car troubles, consider seeking advice from financial professionals. They can provide insights tailored to your situation. Trust your instincts. Just as you'd trust your gut feeling in unfamiliar situations, trust your instincts when evaluating financial claims. If something doesn't feel right, it's worth investigating further. The world of finance can be complex, but armed with knowledge and a critical mindset, you're better equipped to navigate its challenges. Whether it's Robert Kiyosaki's cautionary words or any other financial prediction, your ability to critically assess and take informed actions is paramount. If you found this video insightful, don't keep it to yourself. Like and share this content to spread awareness and empower others on their financial journey. And for more valuable insights, click and watch this video right here.